Now, the Treasury Bills market was mostly quiet this week as investors shifted their attention to the bond auction conducted earlier in the week. Well, traders at Axis Bank say they expect the bearish sentiment to continue due to the thin liquidity levels. Tobechukwu Ikpe, team member Treasury at Axis Bank, joins me to discuss, give us an overview of trading at the markets so far this week. Tobechukwu, thank you so much for taking the time out to join us. Let's start with you bringing us up to speed on today's trading action across the market segments.
Okay, thank you for having me, Esther. So today for the money markets, the market is currently in a ripple of about 320 billion due to the thin liquidity in the system. This was largely driven by the bond auction debit of 375 billion that occurred on Wednesday. So this has impacted the fixed income space. For the Treasury Bills market, we see bearish sentiment as market participants look to fund their other obligations, and for the bond markets, there are also sellers dominating that space as they look to exit their post-auction winnings.
I'd like you to quickly comment on the FX market, the trend that we're seeing there. We'll go back to the treasuries and bond market, but we're seeing the Naira at 420. I believe it's at the INE, correct me if I'm wrong. And I mean, we've seen the Naira stable for quite a while at somewhere between 416, 417, but now we're seeing it at 420. Help us understand this trend, and can we expect the CBN intervention to reverse this trend?
Yes, so we've been seeing the rates at the INE window inch up slightly during the week due to demand for the greenback. It has closed at 420 levels on a couple of days, but we expect that the CBN will continue to intervene to support the Naira. They provide funds for the retail segment via their invisibles interventions and for the small businesses via their interventions for SMEs. They also continue to provide funds for the foreign portfolio investors. So the CBN will provide support to the Naira and stabilize rates in the market.
Now, for liquidity levels, I'm not sure you mentioned this, but at what point can we expect the trend to be reversed? I'm talking about the thin liquidity at the market. Also, talk to us about rates, the one-year rates for the Treasury bills, the 182-day rate. Talk to us about the trend since Monday.
Okay, for the Treasury bills market, currently rates for the 1 year is currently trading at 4.5 to 4.4%. This was due to the decline at the last NTB auction last week, where rates dropped about 9 basis points to 4.7%. So combined with thin liquidity, market players are pricing the bills lower, looking for where they can deploy their unmet demand at the primary auction. For the reversal in a thin system liquidity, we expect that to happen next week, given the federal allocation inflows expected in the system from the Federal Economic Council meeting that is scheduled to take place next week.
Now, for the bond market, talk to us about the trends with the yield curve. I know that some on the longer end of the curve for the long-dated bonds, one or two of which were new issues on the part of the DMO, and we did see rates inch up. Well, this was about, if I'm correct, 2-3 weeks ago. I just want to get a sense of what the trend has been since then.
So since then, market participants continue to expect rates to go up for the bond space. This was evidenced at the last auction, where they priced their bids for the 20-year reopening, and the rates went up by 10 basis points, close at 13%. So going forward, given what the liquidity levels in the system are, will determine where rates will be for the bond auctions.